Adam Hindmarch from Prosper Property Advisory. Thanks for dropping by. I just wanted to follow on from our previous story about the property clock to share a personal story of mine about how I started out investing as the world's worst property investor. So it was early 2000s. I was down at Glenelg in Adelaide, which is a beautiful part of South Australia. Stumbled across this setup for a display for an apartment block which was being sold. And my thoughts were, how could you lose money on a property in Glenelg? So about a week later, put pen to paper, signed a contract and entered into a contract for a property which was being delivered in about 18 months after that. So that would have been 11:59 PM on the property clock. Prices were at their peak and a completely wrong time to be starting out or to be buying in that area. Fast forward 18 months, property's being delivered and we'd paid $389,000 for it, which at the time was quite a bit of money for a property in Adelaide. Valuations were starting to get tight around that time and a lot of the properties within inside that complex weren't valuing in on the same contract price. That's purely because the property cycle had tipped over. So if you imagine that property clock again, it had gone from that peak of the market at 12 o'clock down to 3 o'clock, which was meaning we're in a declining market. So we held that property for 5 years exactly and ended up selling it for $365,000. That was the best price we could get, losing $24,000 on the sale price. Over that time, it cost us over $6,000 in holding costs. So overall had dropped $30,000 on that investment. So that was a pretty tough lesson on how not to invest in property. So when you're looking at buying a property, it really pays to do the right research, speak to the right people, get the right advice on where to buy, what part of the cycle that property is actually in or that location's in, and how to buy the right property. Thanks for that.